Hello everyone, good morning. Welcome to our very first podcast series named as Trends with Benefits, wherein we reach out to professors and SMEs like yourself and get some candid opinions on the latest issues or trends that we would be discussing. So without further ado, let me introduce Professor Florescu, Professor Dragos, and Professor Calhoun. Thank you so much for joining. And today we'll be discussing a very interesting topic named as stock market trading for beginners. So on that note, let me start the first question. So what do you think should be the first step for, getting started with like someone who is interested in trading and they want to get started? What should be the first step for them?
I think Professor Calhoun teaches a 101 class for our freshmen coming in. Okay. Where the topic is more or less related to this. I'll let him answer this question.
Okay. What I always tell people is when they're just getting started, they have to figure out, in a way, who they are, what they like, what they don't like in terms of what the market is going to do to them. Some people are very nervous once they make an investment. Some people are less nervous. Some people react very badly to a loss. The market is going to not reward you perfectly ever, and in the sense that you don't buy today and it immediately goes up, or sell today and it immediately goes down. You never can be perfect in your timing, and so you have to figure out how you react to loss, to risk, to volatility, and that's an individual matter, as I have discovered. Some people are much more tolerant of volatility. Some people are much more focused on not losing than they are on winning. Some people are more gambling oriented. All of those types, those personality types can do well, but you don't necessarily know who you are in the market until you get into it. And so I always advise jump in, explore, figure out who you are, and settle into an understanding of what they call it a risk profile, what your risk profile is.
So you want to advise that it's the mindset first that they need to set rather than getting directly into the information overload which is already present everywhere.
Well, the information that's out there is so enormous in quantity that I don't think you can start by saying you're going to learn everything and then invest. And that the point is that the information is only half the battle. The other half the battle is inside your head. It's inside your psyche, and what, as I said, what your reaction to how the market is going to behave, what your reaction to it is. And different people have different types of profiles. Some of them are very safety oriented. Some of them are more, they like the risk, they like the excitement of the gambling aspect or the speculative aspect. Some people want to invest and hold for a long term. Other people they like the entertainment value of day trading. But you kind of have to figure out who you are. That's the other half of the problem. In addition to the information that you want to absorb, you have to figure out what your mindset is going to be as an investor.
That's really informative. So today we actually have a fellow student who is pursuing his master's in BIA, and he is actually not known to anything in finance, or he has not even probably seen much of stock market, and he actually has some questions that he would like to address, because he always felt that there are many silos or many terms which are not known to common people. So there's just some few questions that he would like some insights on from you guys.
So as Kinjal said, I am not aware of anything about stock market. So my first question is, what is ticker? So can you please explain about that, Professor?
No, I just before I answered, right, your series of questions, I'd like to add a little bit to what Professor Calhoun said. Again, for beginners, right, so obviously they get very excited, right? So it's like, I can go back, gambling in a casino, or you can go on Wall Street, which seems more appealing, right? So basically what they have in mind is like, how can I get the highest return, right? So typically this is something that is not a kind of a complete picture of what is going on, right? So another side of risk is the risk, right, associated with all these positions that one may take, right, and trades and so forth. So I think it's important, again, when we're trading, right, to try to understand the markets, right? What does it mean, the markets? What does it mean, the instruments that we are trading, how they are traded, and what they represent, right? Because there's wide variety, right, of these instruments. And each one of them have, again, different risk associated with them, right, and so forth. So it's a risk-adjusted perspective is something that usually the incoming trader doesn't have that picture. Okay, so
I would add to that. Actually, basically, both of you had the same thing that I would like to add too. So when you start like trading, right, you have to decide on what's the money that I have to invest, and how risky my investment do I have to be, and that's the point that Dr. Calhoun is making. Each person has a different risk profile. Some people are more risky, some people are risk adverse, So, and that's the same thing. So that I think the most important thing is to look beyond the how much money can I make, and go into direction of how much money can I make with as little risk that I'm comfortable with. Everybody understands the most risk you have, the more, and that's really a very complicated question. And that's part of the finance courses that we teach here, right? Yeah. Now to answer Arjun's question, so what's a ticker? The ticker is it's actually a very good question, because different exchanges, every data provider provides its own, kind of identifier where you can identify a standard instrument. But so a ticker in some way, it's think about it as a standardized product. So I want to buy a laptop, right? Well, there's a million types of laptops, right? Lenovo, and within the Lenovo, for example, laptops, there is 15 different models. Well, a ticker identifies a unique model and a unique year and a unique everything for a product. So, and then it allows people to buy and sell the certain product. So when I say I want to buy this particular ticker, I'm buying this particular product. Okay. So it doesn't let confusion go in.
Okay. So my next question is, as you can see, recently there is a lot of fluctuation in the stock market, and if you see the Netflix share price, it went more than 50%. So will you advise beginners like us to bank on Netflix? What is the possibility that Netflix will come back up? Like, how many years should we hold the stock? So now it was around $400. Now it's less than $200. So it's less than more than 50% price. We get a cheap price for Netflix. Should we buy Netflix now? So how you will advise young people like us to analyze the situation?
Well, first of all, I'll say I never give advice on specific stocks, because it doesn't. It usually doesn't work out happily for both parties. But when a stock suffers a big drop like Netflix did, there are two interpretations. One is that the market has overreacted and has punished them more than they should have, and it could be a buying opportunity. The other is that Netflix is in some serious trouble and they're not going to get out of that trouble anytime soon. And so you probably don't want to view them as a buying opportunity at this moment. This is the central problem of what's called value investing. Value investing is what Warren Buffett, for example, engages in. He's the champion of value investing. Buying companies, buying stocks that have been beaten down, punished too much, possibly, and are therefore cheap relative to their fundamental value. So if you see an event like the Netflix collapse, it could be a value investing opportunity, but you don't just dive into it without doing some homework to try to figure out, is it really a case of having been beaten down too much and being undervalued, or is it now properly valued because Netflix is in some serious trouble with their business model and may not recover from here.
I have something to say about this particular case. So I would completely agree with Professor Calhoun, but I have something to add. So this has been a complete shift in the way markets operate since 2000, early 2000, and today, 2022. What does that mean? Well, today we have way more investors, more people buying stocks than they did 20 years ago. 20 years ago, you had to have a broker, you had to have a large account, you weren't really allowed to trade directly on the market, you had to call your broker, and then the broker would give you also advice about it. So the sums that were going on and the movements that were going on were well thought out and, completely changed. Today, anybody can buy and sell stock. That basically makes it so that any news that comes up, it's completely exacerbated and, it's being overreacted by the market. This is happening all the time. Now, the way I know this is because I teach time series. And I've been teaching time series since 2005. So in 2005, we used so-called linear models. And we were able to kind of derive a linear trend from analyzing the financial market. And at the time, there was something called heteroscedastic effects, conditional heteroscedastic effects, that is how the volatility is moving. And back then, in 2005, there was very little this effect. Today, if you analyze the same time series for the last, daily data, and using the last 5 months, 6 months, a year, 2 years, you're going to see that there is almost no trend. Any stock that you see, there is no trend. But instead, the volatility, this conditional heteroscedastic effect, it's huge. There is almost no instrument where this volatility is not significant. So what that means is that the stock fluctuates a lot more today. And on the average, the movement, there is no systematic trend that you can actually see or detect anymore. So in this particular instance, why is that? Why is this happening? Well, there is a lot more information today than there was, 20 years ago. So in the Netflix case, for example, just to take it as an example, right? The reason this happened is because Netflix posted a message that said they lost 15% of their subscribers, or some number, I don't really remember exactly the percentage. And then immediately the stock dropped. Now, I can tell you because, I'm sure you all know, today, as opposed to maybe 10 years ago, Netflix is not the only provider. We have now Disney Plus, we have HBO Plus, we have HBO Max, we have, Amazon Prime. We have lots of streaming services. Now, what is uncertain about that is we don't know if the people who actually moved are going to come back or not, right? So this is really, I think it's an overreaction of the market. And the reason it's an overreaction is because nobody really knows what the future lies. So they automatically assume that everybody moved to these other platforms. But if you think about it, it's not true. Because for example, I subscribe to 4 such platforms. Amongst them, one of them, Netflix, right?
So you guys are getting to the point wherein that due to the ease of information availability and lots of technology available where everyone can trade. So you're telling that the microstructure will be overshadowing the fundamentals. Is that what you're saying?
That's exactly what I'm saying, yes.
So how strong will the value investing hold? Value investing, is it now a lost concept? Is it something that won't hold in future? Is that something you want to give your opinion on?
I think in my perspective, the value, so I'm a mathematician, right?
Yeah.
I never understood the finances and the accounting and so on. And I always call them, not really significant because it's about the market perception of the company. I always thought that. But I will tell you now that after 20 years of going through this, I think the value of a company is actually much more important than it used to be. Because I think right now it's much more important to know what the fundamental value is in the presence of all this fluctuation of the market that's going on.
Okay. So maybe now the value investing, the hold just gets longer because of the fluctuation taking bigger role in it. Okay, that's helpful.
So my next question is, Professor, there is something called as bull market and bear market. So now, since the market is in downward trend, it's called bear market. So will you recommend the investors to buy now, or the young traders to buy now? And if they buy, how long will you ask them to hold the stock? For example, Twitter is fluctuating a lot right now because of a lot of news that is happening around Twitter. And it was around $50 2 weeks back. Now it is around $38 to be precise. So what will you suggest the young people right now?
Well, that's a difficult question. So basically this question comes back right to trends, right? So basically the two major things, right, is trend following, right, or mean reversion, and this one comes that to having a model, right, model of the price, and the idea again as discussed previously, right? So if you look at the efficient market hypothesis, right, says that if the markets, let's say, include all the possible information, right, then the price, right, should reflect, right, the value of a particular instrument. So basically, right, if this is not happening, right, then you have such mispricing or misvaluation of the instrument, right? So then the question is, right, what is the horizon, right, and what such probability may be. So it's very hard to say, right, if this trend, right, may continue, or it may have, right, a mini version, right, to previous levels.
Okay, Professor.
So wait, Dr. Calhoun, do you have?
Yeah. So again, referencing back to our favorite super investor, Warren Buffett, what he would tell you is that in the moment where everybody is selling and panicking and the market is crashing, it's the best moment to buy. In October or November of 2008, he wrote an editorial for the New York Times where he said this is the best moment ever in his career to buy in the stock market. Had just fallen 3,000 points and everybody was ready to jump out the window. But Warren Buffett said, no, this is the time to buy. And he would have been right. He's, by the way, just recently said he's going all in on U.S. equities, on the U.S. stock market right now. Again, I think it's a signal that if you're a value investor, you want to go against the trend. And when a bear market is a serious bear market, that's when you can really make money if you have the stomach for it, the stamina to get in against the crowd. So I think in general, I would say that you ought to be on the lookout in this type of market for good opportunities to get into the market, not to escape from it.
So my next question is, Professor, so what does a portfolio mean? How does a beginner should build his portfolio? Should he invest in the trending stocks, or he should invest in stable stocks and try to build his portfolio step by step? So how would you recommend a young trader to build his portfolio?
Well, I will first just say that the word portfolio has two different meanings, a strict meaning and a loose meaning, let's call it. The loose meaning people use, they say, I have a portfolio. They mean just those are the stocks that they happen to buy. They like them, they like the companies, they like the stories, and they buy Netflix, or they buy Tesla, or they buy NVIDIA. The strict meaning of portfolio, which Professor Florescu and Professor Bozdog can comment on, is a very different thing. It's a structure for managing the risk or the volatility of the entire set of holdings, and every individual decision that you make to buy or sell is constrained by all the existing positions that you already have in the portfolio. So you're not free to just buy NVIDIA because you like it. You have to look at whether or not it adds or subtracts to the volatility, the correlation characteristics with the rest of the holdings. But I'll let the mathematicians comment further on that.
Okay, thank you. So again, the portfolio concept, right, is related to the risk. That's something that I said previously.
Okay.
Right, so managing the risk, right, because the names that are in the portfolio are not independent. Okay. Right, generally, people talk about correlation, right, as a measure of the relationship, but there are other measures, right, of the dependency between variables.
Okay.
Right? So the goal of this, again, is to have a target, right? To have a, let's say, an expected return which is adjusted for risk, right? Which implies measuring the risk, right? Which is not a unique way, right, to measure the risk, right? So there are different ways to approach this. So the construction of the portfolio, right, have to satisfy certain criteria for risk, right? And also for the horizon of the investment, right? So the structure of the portfolio may be different if you invest 1 month or you have a 1 year or 30 years, right, perspective.
So that, Professor. So next question is, so in the stock market days, are there a particular time where people sell more or buy more? Is there a particular time that we should be on lookout for?
Well, I'm generally against day trading as a philosophy. I think it's a very difficult game to play, especially for beginners. But it is the comment I'll make to your question is that the first half hour and the last half hour see by far the largest amount, the largest volume of trading and the biggest moves. So I guess I would say in general, if you're looking to get the stable, accurate price, you don't necessarily want to be involved in the opening 30 minutes or the closing 30 minutes.
Okay, Professor.
Yeah, that's correct. Also, I would say in our studies that I did with Dragos, when we looked at the daily trading activity, we found what Professor Calhoun mentioned, the beginning and end of the day is the largest activity. So basically the price fluctuates a lot more during that period because everybody, tries to buy and sell. But we also ironically found a period during the day, which were around like 1 o'clock, and we were like, what is going on here? Because the activity kind of spiked every day at around the same time. And then we figured that might be some announcements, or it might be just a simple explanation such as the traders go to lunch. And when they go to lunch, they start to discuss, and then they come back. I mean, this was data from 2010, so it must be, it might be.
Rare events, right? So
Yeah, particularly right. We were looking for rare events. So that is a lot of market movement with very little associated volume. So this typically happens when there are news, when there's like some, information going on. So it's almost like the traders go to lunch, and then during the lunchtime, they don't want to trade because they don't want to, but then once the lunchtime it's over, they basically start putting trades in.
That's interesting. Yeah.
So can you please explain what a stop loss is, Professor?
So stop loss rule, it's basically the professors mentioned earlier. When you start to do trading, you should understand a little bit about trading. You should understand what is a bid. You should understand what is an ask, right? When you're trading the two sides of the market. There's almost like when you're trading IBM, for example, just to give an example, there's two different prices that are going on. One for which people are willing to buy IBM from you, and then that's the ask, and that's the bid, and then people who want to sell you IBM, that's the ask, right? So there's almost like two different auctions that are going on in parallel. So you need to understand basically these concepts, right? And the stop loss is if you get invested, right, you buy IBM, for example, or you sell IBM, at any moment you can compare the value of your asset versus the value of the market. The market is going to move whilst your value stays the same. That's the value that you bought or sold the asset for, right? So it can happen that at some point you're going very, very much in the negative, okay? And by the end of the day, if you're a day trader, you typically have to close your position, and then because otherwise there's like fees that you have to pay. Particularly, I mean, this is more applying to an institute investors really rather than a private investor. But there are rules that you set in place. And stop loss rule is one such rule. It says, if I lost this much, that's as much as I can afford to lose. And then when the stop loss is triggered, then you basically liquidate the position. Either you sell the asset or you buy back the asset that you sold.
Okay, I guess.
So let me just try to add something if you like adding, right, regarding the stop loss, right? And part of the rules, right, so the trading, right, it's like a multi-stage system, right? So you get information, you process the information, and typically when you enter the trade, you get a signal. And that signal is generated by models. It's a good opportunity, it's undervalued, overvalued, so typically, right, you want to exploit that. So you get a signal, right, to enter the position. And then you need, you're going to hold this position for a while, and maybe need to exit. So the execution, right, based on that particular signal, entry and exit position, right, is another module, right? It's a decision system, right? And all this pipeline, you are doing this in order to get something, which is, let's say, risk-adjusted return, right? So you want to maximize your objective function given by choosing the best rules, right, which are based on a particular signal generator, right? If you change the model, you're going to change the best rule generator for that particular objective function. So it's a multi-stage process. It's very hard, again, to have global optimization of this, right? It's like heuristic algorithms, backtesting, and so forth. Right? So that's, the stop loss, right? It's a small part of the rule-based system.
Okay.
Thank you so much for being a sport and being so honest and candid about answering the questions. And on that note, I'd like to end our first ever podcast. So congratulations on that.
All right. Thank you very much.
Yeah.
All right. Thank you.
Thank you.
Thank you.